Hello, welcome back to the channel. So in today's video, I'll be covering some quality stocks that have been falling, as well as why I just trimmed my largest position. So for reference, this is my entire portfolio here. I have a 10% stake in Google. It was previously at around 12%, and I actually just trimmed my position in Google, and I'll be covering it in today's video. Besides that, there are some other companies that I'm looking to add into as well, which have fallen after earnings, which I'll be covering in today's video. So let's talk about Google first. Google, since the April low, is actually up around 50%. It is currently trading at a 25 times of earnings. So for Google, it's actually gotten to one of the largest gainers in my entire portfolio in a very short period of time. So Google is currently up around 44% since I started buying into the company. My cost basis is around $160. So for Google, it has actually been a winner in a very short period of time, and that's why I've taken some off the table. So for Google, besides that, we'll be covering some of the risk. So of course, you have your DOJ risk, which is now settled. The company has a clear runway to becoming the largest AI company in the entire world. Besides that, your LLMs taking over is something that Google have basically defeated as well. So the company has been posting fundamentally great results. Ever since ChatGPT came out, earnings have been growing strongly. Google search has been quite resilient throughout this entire time. So this is another risk that the company has diminished over time. So for Google, the reason why I'm selling out of the company is because I still feel the company is facing a lot more competition than it has experienced in the past. So while the stock is currently up $230, this is probably the time for you to be a bit more cautious as people become more euphoric as the sentiments change for the better for this company. It might be time for you to take out some gains from this company. I still have around 10% of my entire portfolio in Google, so I still feel it's substantial. But I've said it time and time again, even before the stock rallied all the way to $200, that Google is currently a company that has the greatest downside risk in my entire portfolio, besides ASML of course. So that's why I decided to trim my Google position, and it's mainly for portfolio management purposes. So for Google, the current valuation today is also re-rating already. So you're seeing a much closer valuation between Google as well as Meta. So Meta is currently trading at a 26 times of earnings. Google is currently trading at a 25 times of earnings. So we're seeing some similarity in terms of valuation. So the undervaluation relative to the peers is more or less gone already for this company. So for Google stock, the competition just started for this firm and sentiments have been following the price. It's still a substantial position in my entire portfolio, but the one with the greatest risk out there. Besides that, valuation puts it at a fair value of around $200 to $220 a share. So I've trimmed it for portfolio management and risk adjustment. I think the company fundamentally is still extremely sound. It will probably still get around market beating returns at this price given the earnings growth. But for me, it's the company with the greatest downside risk, and that's why I actually trim my position here. Next, if you're interested in signing up for a broker and you haven't gotten into one yet, feel free to sign up for Moomoo. You'll get exclusive rewards signing up with my link in the description below. So if you deposit $100, you'll get $20 worth of Nvidia shares. This is an affiliate link, so if you're interested in supporting the channel, please feel free to sign up. Next stock that I'll be covering today is actually another one of my holding. This company is Copart. So Copart is actually now trading at around a 28 times of earnings post its earnings report, and it is down around 5% today after its earnings report. So for Copart, if you were to look into their earnings report itself, revenue growth is stagnating, it's slowly declining. Gross profit actually went up by 12% year on year from last year's quarter, and operating income actually went up by around 14%. So what this means is that the company is expanding its operating margin, expanding its profit margins as well, which is overall bullish for a company like Copart. But of course, there's the fear that the revenue is slowing. So year on year, your revenues have actually gone up by only around 9.7%, whereas your operating income is only up by around 8%. So besides that, Copart is a company that is exercising operating leverage. So operating leverage means that your fixed cost is getting larger as a proportion of the entire cost of the company. So for Copart, they've been buying up lands for all these different years, and now we're seeing some form of reward as well, as they're able to suppress their costs, they're able to suppress their variable costs, and basically keep their fixed costs at a certain level. So what this means for Copart is they're able to expand their margins, and this is what we saw in the last quarter. So margins are currently at around 34%, highlighted by this line here. So over the past few years, this is actually one of the highest points in terms of profit margins, and I expect the company to be able to continually do so, especially as the company has been buying up all these different lands. Next company that I'll be covering is Lululemon. So Lululemon is now around 18% today, currently trading at an 11 times of earnings. So for Lululemon, this was their earnings report. So net revenue went up by 7%, comparable sales increased by 1%, gross profit went up by 5%, and income from operations actually decreased by 3%. So when you see a company like this in the fashion industry and their top line stops growing, that is when they're in trouble. So in Lululemon's case, their American revenue is actually not growing as much. Their international revenue is the one that is pushing up the revenue growth for the company. But the problem with that is they have 75% of their sales coming from Americas, whereas only 25% is international. So while the international portion is growing quite rapidly, it is still a very small chunk of Lululemon's entire sales portion, which is the worry of the company today. So for Lululemon, here are some of the potential theses for the company. So first of all is that your international expansion will actually offset the US store decline, but so far net profit hasn't been able to hold up. So their net profit actually dropped by around 3% this year. It's the first time that they've dropped in terms of net income for a very, very long time. Besides that, in your international portions, they won't be able to exercise pricing power as much as they've been doing in the US. So because a lot of these international countries are actually third world countries, they won't be able to exercise their pricing power so much, so their margins in those countries will be a lot lesser as compared to America. Besides that, the second thesis for the company is innovation. So we saw what happened with American Eagle, the Sydney Sweeney jeans ad. So if Lululemon is able to come up with something similar as well, this could be a tailwind for the company, but of course this is all if, buts and maybes. The company continually requires something like this, which puts it at risk of innovation risk. And that is why I hate investing in fashion stocks like Lululemon. The next company that I'll be covering as well is Salesforce. So Salesforce is down around 25% year to date. It reported its earnings around 2 days ago, and the stock dropped by around 5% on the day itself. It's currently trading at a 36 times of earnings, and price to free cash flow wise, it is currently trading at a 25 times. So for Salesforce, I would say their earnings were quite decent. It's more or less in line. So revenue went up by around 10%. The GAAP operating margin actually increased to around 22.8. Non-GAAP actually went up to 34.3. They returned $2.6 billion to shareholders, including $2.2 billion worth of buybacks and $400 million in dividends. They are announcing a $20 billion increase to Salesforce's existing share repurchase program, bringing the total to $50 billion. So for a company like Salesforce, the problem with it is the revenue is decelerating by quite a fair bit. So currently now we're seeing revenue growth at around 10%, which is a historical low for a company in this space, a software company as well like Salesforce. So what that means is the volumes are actually declining and they're not able to exercise that pricing power as much, which is a problem with the company today. So for Salesforce, because the fundamentals are decelerating, the fundamentals are deteriorating, I don't think it's a company that interests me today. It is currently still trading at a decently expensive valuation. And for me in the software space, you have other companies like Adobe coming up, which are much cheaper and possibly higher growing as well as compared to a company like Salesforce. Next company that I'll be covering is Duolingo. So Duolingo year to date is down around 17%. This is the peak that it had post earnings. It is down around 50%. So despite the drop that it has had, the company is still trading at 110 times of earnings at around 75 times of EBITDA. So the company is still expensive. I don't think this company is one that is interesting at all today. And so I'll be suggesting two stocks that are much more interesting, which operate a lot more boring businesses, but of course more durable businesses as well. So the first company that I'll be covering is Otis. So Otis is down around 6% year to date, currently trading at a 22 times of earnings, giving you a 2% dividend yield. So if you were to look at Otis in terms of historical valuation, it is currently at one of its lowest points in its entire history. And for Otis, it is one of the most predictable companies out there. Although there's not much of a thesis for this company, I view this as one of the theses for the company. So a lot of the company's revenue is actually in China. I believe it's around 17%. And the reason why the stock has been falling, the reason why the fundamentals have been deteriorating is because of China's housing market. So this is China's housing market over the past few years. As you can see, we saw a boom in 2017, we saw a boom in 2019, and currently we're seeing negative growth in this China housing market. So if we're able to see a recovery in this Chinese market again, then this will be bullish for a company like Otis. We're currently at an inflection point in terms of the trend. So over the next few quarters, if this Chinese portion can recover, then Otis will probably return back to growth. The next company that I'll be covering as well is United Health. So United Health is up around 2% today, and it is still trading at a 13 times of earnings. So for United Health, you're seeing price increases, you're seeing target price increases from a lot of these investment banks. So for example, this investment bank actually raised their target price for United Health to $379 a share. So we're seeing a lot of price increases after Warren Buffett bought into the company. I still feel United Health is probably one of the better buys in the entire market today. They can easily increase their prices next year given the short tail insurance. So it is probably a transitory thing. It is a one-time thing that is hitting the entire insurance industry today. So for United Health, I still view it as one of the better buys in the entire market, along with all your different other insurance companies. Last portion, I'll be covering some questions left in the comments. So the first one is Interactive Brokers. This commenter actually wanted me to discuss this company. I use Moomoo, IBKR as well as Weibo, and IBKR has a decent interface overall, although it's a lot more professional. So this company is expecting upwards of 20% in terms of user growth. I think the company is one of the higher quality ones out there in terms of your brokerage market. But of course, I'll be waiting for a drawdown in terms of the entire stock market before I start looking at these companies in this sector. Next comment it says, great Chagi analysis. And Chagi is experiencing slowing China growth. It is not a big issue for me as a shareholder, as is their ex-China portfolio, which is primarily Singapore, Vietnam, Indonesia. If they cannot find same-store sales growth in the fastest growing regions in Southeast Asia, and my thesis is busted, I'll give it another quarter or so, but my patience is starting to wear thin. So for Chagi, the stock is now around 50% since the IPO. It is currently trading at an 11 times of earnings. So for Chagi, the problem that I had with this company when I was analyzing it is simply just the cannibalization of their entire business model. So the company grew by, I believe, 800% in one of those years. I think 100% last year as well. So the company has seen rapid growth because of store expansion, and it is currently now hurting the company. If you were to look into the store density for a company like Chagi, a lot of the stores are actually situated quite close to each other in China, of course. So for Chagi, this is the problem with the company. So for this company, I view this as a high risk, high reward. Although the company is probably very undervalued today, it is one that I won't invest in simply because the company is too unpredictable. So for now, I'll be staying out of this one. I hope you guys have found this one useful and invest.